Effie Zahos, welcome to Property Insights.
Oh, it's an absolute honour, Mark, to be here.
Ah, come on.
It really
We know
is.
each other for many
You've
years.
had some amazing people. I'm in great company.
Yeah, well, we've known you for forever. I mean, you've been a Channel 9 personality for, I don't know, for as long as I seem to be able to remember, maybe at least 20 years, 25 years.
I think you're the only person that recognises that. I wish 9 did.
But it's been there,
I have,
would it be
actually.
25 years?
More, probably. I think the first gig, so to speak, I got was with Kerry Ann. So I've got to thank Kerry Ann Kennelly because she had me, CAC had me on her midday program, and that was before anybody was talking about money on like prime time.
Yeah.
So it was great honour for her to actually say, hey, she took a chance, Effie, come on, let's talk about money at midday. And then things just kind of snowballed from there.
And how much of that, because that show in those days, when Kerry Ann was doing it, had been predominantly watched by, in those days, what they call housewives.
Yeah.
And therefore, no doubt the producer of the show is wanting somebody to be able to relate to the people watching the show, and then they can have a female expert talk to them as opposed to, you know, a bloke talking to them. So it's all about relatability. But how much of that has been a mission of Effie Zahos in her career, talking to women, and I know kids as well, now you've got kids, but how much of that has been an Effie Zahos mission?
Yeah. That drives me, Mark. Yes, I do have kids. They're not kids anymore, 22 and a 17-year-old.
But prior to that, you were...
Has always... I don't know where it's actually come from. I've always had an interest in finance. My favourite subject at school, and I went to Broadbeach Primary, was economics. Mr. Higgins, if you're listening to this, you inspired me.
He will be, for sure.
For sure. I've always had a passion for finance, and whether that's come from my background, whether there was a lack of it, or whether I thought we could have done better, or there is obviously things that have driven me to that. And I really believe I'm a communicator above everything else. And for me, what drives me is passing on that knowledge. I actually get off on delivering information and delivering it as best as I can and as unbiased as I can, because financial literacy is so important, so important. My parents didn't have it. They did the best they could for me, and I just want to pass that on. And I think to be able to do that over several, couple of decades, 25 years, 30 years, and do it to the best of my ability and still be asked to talk to consumers, it is a privilege.
So the typical way you would do those sort of things is obviously you do it on Channel 9 as one of their the finance person there. You do it in various other places where you get asked to do commentary. But the typical way is through books. Now, you've done a couple of books.
Yeah.
I mean, I've got one of your books sitting on my shelf, and I haven't read it.
Have you read it?
No, I haven't read it. But it says, Ditch the Debt and Get Rich. But I noticed in the brief there's another one here, A Real Girl's Guide to Money. That's pretty clever. And The Great $20 Adventure, is that what the name of the book? The Great $20 Adventure, Real Girl's Guide to Money?
Yeah. So
tell me what's going on behind those books, and what can people get out of them if they buy them and read them?
Yeah, and they don't have to buy them. They go to the library and get it for free. I'm not
Totally.
My publisher will probably hate me for saying that, but as long as you get out and read something. And the first one, The Great $20 Adventure, really came about because of my son. I remember walking past his playroom, and for parents, you probably are very well aware of what's called Skylanders. They cost about $14 a pop. He had a mountain of these Skylanders sitting in his playroom, and I quickly did the sums, and I thought, my goodness, that's a deposit on the house. This kid's never going to leave my home. He's always going to be home with me. And so I wrote a book about this little boy who gets $20 from his grandparents each, birthday, and it accumulates.
Or in your case, name day.
Yeah, double that. And it's funny, Mark. My son goes, but book gives me more than $20. Why did you write $20 in the book?
And he's smart.
And it basically, he goes for this walk, and all these characters, little animals, are there, and basically saying, "Hey, what are you going to do with it?" So there's Donnie Dangerous, and saying, "Hey, I hear you got $20. So I can double this for you." So obviously, he's the scammer to watch out for. You have Queen Bee, the entrepreneur. You have the squirrel, the flamboyant peacock. So all encouraging him to do different things. So that was written for him.
What age group is that written for?
Look, it's really for parents to read to children, anywhere between, say, 2 2 to 10 and encourages discussion. Then I wrote Real Girl's Guide to Money from Converse to Louboutins, and that's recently been updated. That does actually give a bit of personal insight into me, into what's happened with my life. I think with money, women, there's a lot of stereotype with women. There's a lot of fear with women investing.
Do women stereotype themselves?
Absolutely. And women are actually, dare I say, very good investors overall, tend to research a lot more, tend to be a little bit more cautious, but, fear of jumping in can be just as fear of missing out. So I kind of wanted to give an experience for women to start talking about money and just understand that with money, it's more than just dollars and cents. There's a lot of behavioural economics behind why we do what we do. And then Ditch the Debt came later with more strategies as to, how do you start investing? What's stopping you and things like that.
So just in talk, you just mentioned something interesting about behavioural changes or behaviours. And of course the Reserve Bank's been pushing us to change our behaviour in terms of spending.
Yeah.
Over the last 12 or so months. Where do you think the interest rates are going to? Where do you think the Reserve Bank's at? Are they at a pause next meeting for the May meeting? No, not the May meeting, I'm talking about the June meeting. They're at a pause, or do you think they're going to go again, or what's your read on it?
Look, guessing which way interest rates are going to go has become a bit of a sport for us now, hasn't it? I mean, never have I seen so much interest on RBA Day, which is great, but it was never like that. Last one they actually moved.
You can have a bet on the RBA.
Oh, absolutely.
Yeah, you can take a bet.
You can have a bet on anything. There's another little podcast for you to look at, the gambling in Australia, which is just crazy. I know the market said that the rates would not move last one. I actually said it would move. But again, I'm guided by a lot of information I read. I think CBA economists nailed it spot on with their forecasts to date have been pretty good. We've still got inflation really high at 7%. We had the budget that came out, and I know there's a lot of debate. Was it inflationary? Was it not? They were very clever in how they actually gave a lot of the stimulus payments. Think about energy, it will go directly off the bill rather than cash in the hand. Energy makes up, about 2% of CPI. So that's going to actually pull inflation down but disguise it. And the RBA has... In
terms of just the number, though...
Yeah,
you're right.
Yeah.
It'll change the actual number that goes into the CPI
inflation
calculation.
Pressure will still be there.
But I've got more money in my pocket because I was probably going to have to spend more. So what am I going to buy with it?
Yeah, exactly. Yeah. So could it actually...
I thought it was very cleverly positioned in order that they could defeat anybody who claimed that this giveaway is inflationary.
And it was a pure Labor budget, and it was very clever, and you've got to understand why they do things that way, because it does look good for them. But at the end of the day, as you point out, it could actually still be inflationary. The RBA's made it pretty clear this time that they're not saying we're at a pause or anything, quite possible for another rate hike. I think we've got the wage data to come out this week. We've also got the unemployment numbers. So I think it is a case of wait and see. For consumers, regardless of whether they go up another one, I think we've peaked, that's for sure.
Yeah, there's not 10 more ahead of us.
I don't think so, no. Mark.
Yeah.
I mean, what do you think?
But I think we're probably... There could be one or two more in there, but there was not. We're at the end of the series, if I could put it that way. But that doesn't really give us. The question really becomes, how long does the series remain?
Yeah.
So, when do we start going into the reduction series?
Yeah.
And there's lots of commentary out there about that, and it keeps sort of changing. But I think that I'm like you. I called the rate rise last time. Only because I think the Reserve Bank would have been encouraged by the fact to raise rates again by what happened in the UK, what happened in Europe, and what happened in the US. There's encouragement in there. I think that is that they all put their rates up. I think they would have also been encouraged by the fact that house prices didn't tank. And they went up a little bit.
And they're down from their peak, but we've had the last couple of months gone up about 1.2%, the national dwelling value. So they've been resilient.
Yeah, they're sort of saying, well,
migration coming through, more pressure.
Lots of people are going to come and start spending money. And I think they weren't sure. Well, they obviously would have been waiting to see what the Treasurer was going to do in terms of the budget. Now the budget's out. I think there's probably a 40-60 case in favour of a rate rise in June given what come out in the budget.
Yeah.
It's less than half, so it's not
You
probable.
don't think there'll be, we've got about 860 homeowners going to roll off of their fixed rates. We've got the lag effect of rate hikes.
Yep.
You don't think that will be enough to pull back the inflationary pressure that the budget's going to have?
That's
Do you
a very
think it's
good
going
question.
to balance it?
Well, there's 800 and odd thousand coming out this year, and there's another
Yeah.
400 next year. There's 1.2 million altogether. There's a lag period. So those, when we all say 800,000 fixed mortgages are going to turn up to variable mortgages in the next 12 months, it happens. We don't know. We haven't got the data to tell us where does it peak? Where is the peak of that happening? And all I know is that 1 March 2020, those very low fixed rates came in place. 1 March 2023 is the end of the 3-year period that the Reserve Bank lent that money to the big banks to lend to us at 2%. We're only at May now, so we're only sort of 2 months into that fixed rate period. I can just say from my experience, from Yellow Brick Road's experience, most of the borrowers borrowed at the end of 2021, mid-2021, to the end of 2021. So that's when we did most of the fixed rate borrowing, which on that basis, those people won't start to drop off and come into variable rate until 2024, 2025. So, and I think the conversations, Evie, that they have is at home is if they're an investor or they're owner-occupier, they say to their partner if they've got a partner, or they say to their family if they're just on their own, they say something along the lines, well, I've been reading that Bill Evans from Westpac said that the rate's going to come down. So I'm not going to sell. I might be all right. And because I just have to hold on for a while. So what I'm going to do is I'm going to sell the car, and I'm getting a lot of anecdotal evidence of this. I'm going to sell the car, or we're not going to go on the holiday, or we're not going to buy the new car. We're not going to do the upgrade.
Tightening their belts a little
Tightening their belts, reducing their costs,
Yep.
which Australians are quite famous for when it comes to not offloading their property. They'll do anything to hold on to the property.
We are masters of paying off debt, that's for sure, which is probably why I like a mortgage and why I like super, because it's for savings, and we'll do anything to make sure that we're okay with that. I
don't know the answer to the question you posed to me, but time will tell.
Yeah.
And I just want to finish on this before I go back to you. I don't think the Reserve Bank knows either. And I think they're in the same position as us. They're just waiting. They're going, well, let's just wait and see what happens. So therefore, that might be the case for no rate rise to leave on pause. And I go back to the point I made earlier. The question becomes, how long do we stay at these new rates? That's going to be the issue.
That's the big question. And I was saying before, let's not get bogged down. Are we going to see another rate rise or hold or pause? The fact is, households are battling with 11 rate hikes.
And 4 of those 50 pointers.
Yeah. And I know we've talked about this before. We've seen record numbers that have refinanced. My question would be, if I could ask the lenders, which I actually have asked the Big Four, what are you doing to those customers who are unable to refinance with you? So they're pretty much stuck with you. What option do they have? And that is going to be the interesting thing, because we may see APRA change some regulations with buffer rates. I have spoken to so many consumers where either A, they're like, say, 55 years of age or 60, and they can't refinance because no lender's going to give them another mortgage over 30 years because of their age, so they need an exit strategy. Or B, they're on a 6% rate. They see a 5% over there, but the buffer is 3 on top.
Yeah, 3%. They
on
can't
top
get
of
it.
that, and they can't get it. But yet, hey, you're telling me I can pay 6%? That's not fair.
Yeah.
So whilst buffer worked wonderfully for serviceability, protection, and it should still be there, I think when it comes to refinance loans, some common sense needs to apply here.
Because if I change the buffer and I do give you the money, I lend you the money, you're going to be able to afford the property more. Which actually is good, because it means you're less likely to default.
Yeah, that's right.
Or there's less pressure on you.
There's
anyway.
less pressure. That's it.
So why wouldn't the regulator change the buffer? The regulator's pretty tough on the buffer at the moment.
It is, but I know there's a lot of discussion around this, and I think something needs to be done for refinancing home loans, so it can happen. If your lender won't come to the party with a cheaper deal, because those that have been able to refinance, let's face it, they've done it. What's left are those that can't. So what relief are they getting?
That's very interesting, because it doesn't affect if the lender says, and maybe we just quickly talk about how the buffer works. So let's say the prevailing interest rate's 5%.
Yeah.
That's the retail rate a lender might be offering. It's probably not too many doing that, but let's say it's 5% per annum. When that lender goes to work out whether Effie can refinance from her current lender to me, I'll add, in working out what her payments per month are going to be, I'll add 3% to the 5%. So I will assess Effie on 8% per annum. And that will be the amount of money I assume is what she's going to be paying me when I look at her income minus all her expenses, including mortgage payments, to see whether or not she can qualify for me to refinance her.
Correct.
Now, what's interesting about that is, and your point is a very good point, what's interesting about that, already I'm paying 6%. So, and I haven't defaulted. Just assume I've got a clean record for the moment, or Effie's got a clean record for the moment. So she's paying a higher rate. Otherwise, she wouldn't want to refinance with me. So maybe if I change the buffer from 3% to 2%, Effie will now qualify to borrow from me at 5%, which is less than she's currently paying. She's already paying 6%. So if she now is only paying 5%, and we're at the end of the rate cycle, there might be one more in it or whatever, but it doesn't matter. She's paying less per month. She's now changed her 20-year balance to a 30-year balance because she's now borrowing over a longer period of time. So her repayments per month are going to be much less because I'm going to spread her balance over 30 years. Currently, it's spread over 20 years.
Good.
but you might only hold the house for 5 or 6 years. You might be going to sell.
Yeah.
And on average, that's what happens here in this country anyway. People do sell every 5 or 6 years. But also, and by the way, what you've got to factor into that, just as an important point, if it is over 30 years, if interest rates go back down to 4%, then Effie's been paying 6% currently. She might have extra money in the pocket. She might start paying off faster.
Fair enough, yeah.
I mean, you might.
Yeah.
So I think there is a lot of logic and fairness in what you say in changing the buffer from 3 to some other number.
For refinance
loans? Only for refinance.
Correct, yeah.
Not for new borrowers, for new refinance.
Agreed.
And so that people can get into a more comfortable position, pay a lesser interest rate, make the banks compete with each other, bring on the competition, and as a result of that, me or you, the refinancing person, the person who gets refinanced, you're in a better space.
And that's what I would hope to see. It's a shame that consumers have to jump through hoops, do all this rigmarole to get what essentially is the best for them financially. I mean, that should be done automatically. The same applies on the savings side. Let's say you don't have a mortgage. Let's say you are lucky enough to be mortgage free and you're relying on your savings. Well, thankfully, now we're getting some kind of decent return, over 5%. I mean, if you're under 35, you're lucky, you get great rates.
Totally, much better than anybody
I think
else.
we both miss out on that.
I slightly over
just
35.
slightly. I just missed the cutoff. But again, to get those rates, it's crazy. It's not only do you have to meet the conditions, open account, do a certain amount of transactions. It's not easy. For goodness sake, just give consumers a good financial product to reach their goals. We just don't seem to have that. But everything seems to me to be a bit of a marketing game.
Can I ask you a question? And it's a question I've often wondered about. More on the flip side, on the deposit side. Let's say someone sells a property for $1 million.
Yeah.
And they've got no mortgage. Someone who's over whatever, but they've paid their loan off and their property, they bought it for $100,000, property's now gone up to $1 million. They've done well, but they're not rich. And $1 million is all they got. They got their super, but they got $1 million. And they think to themselves, oh, I'm just going to put it in the bank, put it on deposit. You just hit a very important point. The interest rate returns on deposits aren't that great. And two things sort of come to mind. The first one is the Australian government guarantee stops at 250. Would you say to somebody you should invest in 4 different banks, $249,990, so that each deposit is guaranteed? Or would you feel comfortable saying to someone, put it in the bank, just one bank, and just earn your just put the $1 million in one bank and just... But you're only going to get a deposit guarantee up to the 250.
Yeah. Well, okay. First of all, Mark, obviously I'm not a financial advisor, so
no. There's not advice. Just you and me.
I mean, a lot of people don't understand that too. That it is only guaranteed up to 250, and it's spread across different institutions. Australia, unlike what we're seeing in the US, has had a pretty good reputation with its banks and not folding and so on. But to answer your question straight to the point, I would suggest that you do actually spread your investments. And if it's just cash that you're wanting, you pretty much have to, because you're playing the game a little bit. If you're investing in a term deposit, I wouldn't be investing for long, a rising interest rate cycle, so it can roll off and you can capture the next. And then when you look at the way these deals are structured, it's 4 months is probably the time that you need to get the top rate. So yeah, I would be spreading
because
my money.
it drops off after a period.
Exactly, to a base rate.
Yeah.
So yeah, I would definitely be spreading my money across different institutions, so I stay under that threshold.
Because we all seem to know a lot more about mortgages than we know about deposits.
Yeah. Well, it sounds ironic, but mortgages are a lot easier to understand than deposit accounts, which is quite crazy given how much money we do borrow and the cost of a mortgage.
Because there's a lot more deals that are hard to understand for depositors. Like there are some unbelievably good deals, but they look unbelievably good, but the entry interest rate is really good. But after a month or two, it drops off, or it is only available up to 50 grand or 100,000. If you want to put 250,000, you don't get that rate.
Yeah, and so we know what's the ACCC is actually looking into that. It'd be interesting to see what their findings are. My gripe with this is not only are banks slow to pass on the rates, let's sort that out, but then also let's sort the conditions for some of these, because as you point out, I think take a look at one of them. I think Bank of Queensland, really great rate, but you've got to be under a certain age group. You've got to, I think it's maxed at 50K.
You've got to spend deposit so much per month.
Exactly. It's crazy. I just want a good rate for my savings. Why can't I get that?
That's because there's not much competition. There's a lot of competition against the banks in terms of lenders that are not banks, but there's no competition in the marketplace for the banks in terms of deposits, because you must be a bank to take a deposit. So and there are a few institutions that pay cash, institutions that are not banks, but the money you put with them is not a deposit. It's sort of into a fund. Yeah. And they're a lot harder to understand, as you said earlier. It's quite difficult to understand this stuff.
Well, it's also, consumers need to realise that it's their bread and butter that plays around with their margins. Yeah. So, you're not always going to win in a savings account. But, I mean, looking at even on the home loan side, there are banks now that have pulled out on their cash rate, cashbacks.
CBA did. I think NAB did.
Yes.
And Westpac has, I think.
As Westpac.
I don't think ANZ has yet.
So, they're driving this competition, and they're basically saying right now, enough's enough. Most people have refinanced. We don't need to have these cashbacks, and pulled it.
I want to finish off with one quick conversation with you, if you don't mind. It's about kids' literacy. You've got grown-up kids now, but they were little kids at one stage, and you wrote a book in relation to your own child's literacy or lack thereof. Hopefully he's got it now. But what are you doing in terms of kids' literacy? I know you're on a board of a not-for-profit.
Yeah, for Extra.
Yeah, what's that about?
Okay, so Extra is a not-for-profit organisation, grant giving, and basically through grants help improve financial literacy. We have just rolled out a Talk Money program through schools. It is free, so well worth getting onto that website. Over 100,000.
It's called Talk Money.
Talk Money. Yep. Over 100,000 students so far have gone through this. Financial literacy for kids is so important. And I think the challenge for parents is that the playing field has changed. Chances are your child today is that the first purchase they're going to do, it's on an app. It's going to be downloaded that way. And if you're not savvy, then how are you going to help your child? I always say when parents say, my kids aren't good with money, I say, take a good look at yourself, because they've been looking at your money behaviours. So if your kid's not good with money, I would say there is something that they're looking at through you. And it's going to be a combined effort. I think parents are going to be still learning about money because the level field it's changed. Very important that kids do that. I've also just developed a financial literacy money quiz through Canstar there, that basically 21 simple questions, Mark. Can you
for adults?
For adults. And it's not a money quiz about maths. You can be great at maths but still not understand your household bills. I was quite surprised just how many people actually, 54% passed, 46% failed. The average score was 11 out of 21. Men did better than women. And just surprised me, the most basic questions they could not answer, and they were to do with their everyday household bills. So, for example, without giving away all the answers on this quiz, credit card offers you 55 days interest-free. Does that mean you get 55 days on all your purchases? It was the question answered incorrectly the most. which goes to show that in a cost of living crisis, if we don't understand how our products are working, then how are we going to get ahead?
But isn't it for the banks who lend you the money or who give you the credit card to make sure that education happens properly? Or it's not in their interest to educate you? That's an ethics issue, I guess.
That's a loaded question, Mark, isn't it?
That's an ethics question. It's probably been unfair to raise it, but it's an interesting question. And where do people find this quiz? Is it still available?
Yeah, it's Test My Money IQ. Yep, just launched. Google that, Test My Money IQ.
Test My Money IQ.
Give it a go and see where you land.
It's funny, you come out of the, the journalism environment, but if you go back 25 years, there used to be Cosmopolitan and Clio, and they used to have Test My Relationship on the inside. And we've now gone into Test My Money IQ.
Yeah.
Then it used to be, Test My Emotional IQ, or my, husband marriability IQ, whatever it might have been in those days, like 30, 40 years ago. And but you're right, and that's very clever, because if it's only 21 questions, it's probably quick enough to be done.
Yeah.
And you can just sort of do it there with your friend or your partner or whatever.
Gives you an
a
idea
bit of
where
fun.
you stand, and I think it's important that you do understand, like your energy bill. Have you looked at it? Do you understand how the statements are calculated? Energy plans aren't easy, but the more you do know about your everyday household bills, the better you are in place to make sure to minimise some of those. Because for most of us, unfortunately, it's not rocket science. You either got to earn more or spend less.
Yeah.
And earning more can be quite hard. Spending less is all about just cutting back. And both of those require a bit of education.
It's no different to your weight. You either
calories in, isn't it? Yeah.
Something coming in and something going out, and it's the same with money. So it's what's coming in, it's got to be more than what's going out in the case of money. In the case of calories, it's got to be the other way around.
The other way around.
But
I think I've got them mixed up. No.
We need more people like you, Effie, with as much enthusiasm and probably your ability to encourage people as opposed to school people about it. And that's important. We need more people like you talking about money literacy, not just for kids, by the way, but for adults. And we need more people willing to take up the cudgel and have a go and understand these things. So for me, I mean, like Channel 9, Canstar, and everyone else you're involved with, I'd like you to have someone who has got so much experience, who's seen it all, but someone who's still enthusiastic about the topic. Effie Zahos, thanks very much.
Thank you, Mark. Thanks.